Hey everyone, welcome back to the Chain Reaction Podcast. I'm your host, Tom Shaughnessy. I'm a co-founder at Delphi Digital, where we're 5 full-time analysts focused on institutional crypto research. If you haven't checked out the site, visit delphidigital.io while you're listening to check it out. One quick housekeeping item. This podcast is strictly informational and educational and is not investment advice or a solicitation to buy or sell any tokens or securities or to make any financial decisions. I may personally own tokens that are mentioned on this podcast, and you can see all my disclosures at the bottom of the show notes. With that out of the way, today I'm thrilled to have on Alex Wearn, the co-founder and CEO of IDEX, a decentralized exchange built on Ethereum. This is a very interesting episode as we discuss how IDEX, a sleeping giant, grew to become the largest decentralized exchange and smart contract on Ethereum. We discuss competition with other decentralized exchanges, centralized exchanges like Binance and Coinbase, and hybrid competition, such as Binance launching its own DEX. We also dive into IDEX's future, discussing its 2 tokens, one membership token and its staking token, the future of governance in IDEX, and some details on its Layer 2 solution to increase throughput. Frankly, I had no idea IDEX had this much going on, and Alex shares some extremely insightful details around the entire IDEX roadmap. I hope you enjoy, and please share the episode on Twitter. With that, let's jump in. Hey everyone, welcome back to the podcast. Today I'm thrilled to have Alex Wearn on, the co-founder and CEO of IDEX. Alex, how's it going?
Hey, I'm doing well. Thanks, Tom. Appreciate you having me on.
Yeah, appreciate you making the time. So I guess let's get right into it. Give us your background and how you got involved with crypto.
Absolutely. So my professional background, I've been in software development for a little over 10 years now, primarily in product management roles. Started with a marketing analytics startup out in the San Francisco Bay Area after undergraduate. And that was eventually acquired by IBM and continued in product roles at Adobe and most recently Amazon, working in Amazon logistics. The same time, I guess like 2011, 2012, started getting interested in cryptocurrency. There was a Wired magazine article, the rise and fall of Bitcoin, up to $28 and back down to $2. Started paying attention to really, trying to, kind of went down that proverbial rabbit hole, as everyone says, and started trying to understand what this thing was, really what's the value of Bitcoin and blockchain technology. Got really excited in 2014, 2015 with the announcement and launch of Ethereum, kind of extending on the idea of Bitcoin's digital scarcity, the idea that you can have digital bearer assets that can be sent anywhere in the world instantly, but you can then layer on programmatic functionality on top of it. So we did a couple different things with the Ethereum network. We actually started, my co-founder was working on EtherX, which was one of the very first Ethereum products announced. It never came to market. It was a fully on-chain decentralized exchange. I think we'll get into some of the differences of different types of DEX design here in a little bit. But it had some challenges, never made it to market. We then teamed up and worked on a fiat-backed stablecoin in early 2016. This was when Tether was only a couple $100,000 market cap. We got a little bit of traction, but ultimately pivoted back to the DEX idea, but with some insights into how to make it a little more user-friendly. And that's what we came to market with IDEX in October of 2017. We launched around then, and by January of 2018, we were the number 1 DEX and Dap on the Ethereum network, a title which we've held since that date.
That's incredible and a great segue to get into. Can you explain the hybrid nature of IDEX before we get into the nitty-gritty of it?
Absolutely. So like most DEXs, or I guess I should say all DEXs, kind of the unifying characteristic there has to do with fund custody and whether or not the custody is done in a centralized fashion. So most exchanges customers are familiar with it. The term is a centralized exchange, meaning when you deposit your cryptocurrency on the exchange, you're actually giving up control to the exchange operator. And as we see time and time again, that leaves the customer susceptible to hacking and theft. So if the cryptocurrency is not in your control, then you're relying on the exchange operator to essentially give it back to you when you go to withdraw from the platform. So there's a lot of efficiency benefits that come from centralizing those activities, but you have the kind of ultimate fund security risk. So this is where DEXs have kind of started to carve out their niche. It's the idea that instead of turning over control to a centralized entity, you maintain control of the funds throughout the entire process. That's most often done by interacting with some set of smart contracts that allow you to trade directly with another user rather than having to go through the process of pre-funding at a centralized account where they then match the two users up together. But some of the challenges that occur with traditional DEXs really has to do with what's kind of, what components of the application are decentralized. And this is where you have some choices as an application designer. I mentioned the first product that my co-founder worked on, it was what's known as a fully on-chain decentralized exchange, which means that not only is the blockchain responsible for custody of funds and settlement of trades, but it's also doing other things such as hosting the order book and allowing users to match and execute trades. The big problem with that being that the blockchain is both, one, very slow. It takes 15 seconds per block and often multiple blocks before your transaction can get mined by the network if there's a period of congestion. And it's also expensive, where each action costs gas in the case of Ethereum, and you have to pay for those computations. So if you're trying to create a trading platform where users are constantly placing and canceling orders, doing a lot of actions, and you want speed as well as low cost kind of processing, then this type of design can be prohibitive. So this is where IDEX came to market with the hybrid design. And one way to think about it is a centralized exchange with decentralized fund custody. So every action that the user takes, placing, canceling orders, matching trades, executing trades, all of that happens off-chain in our traditional software application stack. However, all of those transactions are accompanied by a signature from the customer's private key, kind of ultimate final approval, such that we can settle all of those trades through the use of our smart contract. So we never take any control of customers' funds. It's always managed directly by their private key, and it's custodied by themselves or the smart contract on the Ethereum network. However, at the same time, from the UX perspective, everything the customer sees is happening off-chain and in real time. So we think it's the best of both worlds, kind of the UX of a centralized exchange with the security and really flexibility of decentralized fund custody.
That's incredible and a great overview. And the trade-offs make a lot of sense. So I'm wondering, what's the disaster scenario here? Like if something happens to the front end IDEX site or something like that, does that mean that, the trading will obviously stop, but funds are safe because it's basically in a smart contract here?
That's exactly right. So there are other elements of I guess maybe you should say attributes that your decentralized exchange can have that we intentionally chose not to develop or focus on in order to make this kind of trade-off here. In particular, what you just mentioned, the terminology is censorship resistant. The idea that even if something happens to our website, even if we just up and disappear, users are always able to trade with one another. That's kind of the terminology for censorship resistant, meaning no outside actor can stop people from trading. In this case, trading on IDEX actually requires going through our platform. So we are not censorship resistant is kind of the characteristic that we've given up on in order to achieve this benefit of a much better user experience. However, the core benefits, what we believe kind of 95, 99% of the benefit of decentralized exchange is that your funds are never at risk. So if we do just up and disappear, you'll always be able to get your funds out of the contract.
That's incredible. And going back to that trade-off, if you guys were to be a fully decentralized exchange from the beginning, what would you lose? I'm assuming you'd probably lose the UX and probably the throughput.
That's exactly right. So fully decentralized, again, would mean, just to take a concrete example, if you go and place an order on IDEX, it immediately shows up and is available for someone else to trade against it. If you take an order, the terminology, right? If you pick an order from the books and choose to execute against it, it executes immediately and it updates your balance in real time. So the UX, it feels like a centralized exchange. If we were to be fully decentralized, each of those actions would have a delay. And also, perhaps more importantly, a lot of these actions that are free to do today, you would have to pay the network a transaction fee. This is particularly important when it comes to market making. So if you think about the job of market makers, they're constantly placing and canceling orders, moving the orders around based on price movement on other venues to make sure that they're offering competitive pricing within this market. And if they had to pay a network fee and wait a period of time due to network latency every time they wanted to place or cancel orders, it makes it very difficult and almost cost prohibitive to provide significant liquidity.
That's excellent. And going into, just to set the stage for IDEX's growth and your success so far, I know you mentioned it earlier, but are there any metrics that you could point to paint the picture of how large IDEX is? I mean, we recently did a report on Kyber for our institutional clients, and we found, I believe, around 70% of trades in the last 30 days since we published the report prior were all handled by IDEX. So I feel like you guys are definitely the dominant DEX here.
Yeah, so as I mentioned earlier, we've been the number one DEX and Dap since about January of 2018, and it's funny. I wrote an interesting article that maybe we could link to in the show notes about actually measuring Dap activity. There was a debate at Consensus between Joseph Lubin and Jimmy Song about Dap adoption, and they were kind of at opposite ends of where they think the Dap market is going to go and how many users these applications can ultimately get. And we kind of chimed in with some of our insights into some of the challenges of measuring Dap adoption. In particular, a concrete example being some of the stuff that happens on IDEX that would be considered an action or an active user doesn't always register as a transaction on chain. Does that count as active users? We certainly think so, but it's not always publicly visible to measure that activity. But there's a couple of ways we look at it. We look at overall total transaction count. So that's just the number of trades that are submitted via our IDEX contract versus other venues. And as you mentioned, that's generally around 65 to 70% market share of trades on IDEX versus all other DEXs. Another way we look at it is unique wallets that have interacted with the IDEX platform. So we just a couple weeks ago passed 300,000 users that have interacted with of some kind, deposit or trade on the IDEX platform. So we've seen a lot of great growth, and we're pretty excited by the adoption we're seeing so far.
That's incredible. Do you think Jimmy's going to win the bet, or do you think Joe's going to win the bet?
Yeah, so I called this out in the article. I think it's going to hinge on, they said they're still settling terms, and I think it's going to hinge on this area, maybe we'll touch on it a little bit, the concept of a layer 2 scaling solution. The idea being that in order to scale applications, you need to minimize the amount of data you send to the blockchain. So you can there's multiple different methods, but the ultimate goal is to onboard more users, do more transactions while using less compute resources of the blockchain itself. And I think that may be a point of contention for the bet, where Jimmy Song was wanting each transaction to have to register on chain. And if that is kind of a sticking point, I think Joe Lubin may actually lose just due to some of the scaling limitations of the primary layer, the layer 1 of the Ethereum network. So he could win in spirit, but lose on technicality.
That's a great point. Yeah, we just did a layer 2 report, and that's really interesting because I definitely agree there that if it comes down to that nuance, Joe might actually lose. Yeah, so just going on to IDEX itself, I mean, you guys have been around for a while. People are always interested in how assets get added and how assets are removed and stuff like that. What's like the process for you or for IDEX in adding assets, removing them? Because I'm just scrolling down the list of your ETH trading pairs, and there's hundreds here, I think.
Yeah, so we try to see ourselves as kind of the community exchange, right? We, part of the ethos of decentralization is that you want to be more inclusive, you want to be participatory in terms of projects that are able to list and customers being able to trade whatever assets that they're interested in. One of the things, we actually had a purely open listing policy early on, and one of the challenges we found was that because it's on IDEX, there is a level of endorsement that's seen by the community. There's an expectation that we've reviewed projects and done some level of due diligence. So we've actually instituted a relatively rigorous review process where for each project that applies, we talk to the team, we do a few Skype conversations, we do a legal review as well as a smart contract audit, really just to make sure that we're not listing anything that could be problematic for our customers. But in the future, I think we'd like to see, we're exploring kind of how can we move towards a more democratic process, maybe something that's done by votes from the community, something that's based on kind of interest from members of IDEX. So something that kind of takes the process a little less directly in our hands.
That sounds like a great transition. It definitely seems harder, but I feel like you guys are somewhat of a sleeping giant. Like I don't hear about IDEX that much, but it seems like you guys are growing in all the right directions. Was that a decision you guys made early on? Like let's focus on building and shipping, and we really don't care about marketing, or am I and I apologize here, just have I missed it?
Yeah, so it's definitely it's interesting. It's been a conscious decision to really focus on building and acquiring customers, which I think we've done a great job to date. One of the things we haven't done quite as good a job on is really just telling the world about the level of success that we've had. And I think that's one of the things. One of the reasons I'm here today is to let viewers know that actually the ones you think of when it comes to decentralized exchanges are not the ones that have the majority of users. So I think it's an interesting space in the sense that sometimes it can be hard to separate the signal from the noise. So we're here to just kind of tell the world and bring a spotlight to the level of success that we're having.
That's excellent. And, I feel like we should talk about competition a bit. We could do centralized exchanges. We could do other decentralized exchanges. Let's start with decentralized exchanges because there's obviously the most stark differences here that you got into earlier. I mean, Binance has seen, insane growth. Poloniex, I feel like, fell off a bit. You have Coinbase adding assets and, they seem very regulatory compliant for the US and a great UX. How do you think about competition between IDEX and centralized exchanges over the long term?
Yeah, so we really see centralized exchanges and eventually traditional financial trading venues as kind of our ultimate competition. And the reason I say that is because we're really focused on a high quality UX that comes from some elements of centralization. As I mentioned earlier, we think that in order to have the best trading experience, it's important that we have a large portion and actually a majority of at least the computationally intensive portions being run by ourselves in a centralized application stack. However, we have this unique competitive advantage, the idea that custody is never maintained by us. And I think it's starting with this interest in self-custody. So individual users want to custody their own funds via Ledger, MetaMask, something like that allows them to have ultimate control of the funds. But we really see this as a flexible custody model. The idea that if you trade on a centralized exchange, you're forced to use whatever custody solution they provide. And that may not work for a large portion of customers. Maybe you're interested in self-custody, or perhaps you have regulatory requirements, or maybe for whatever reason you want to maintain your own custody solution, or you have your own custody provider you work with. So our goal is to make a system that is, as long as you can communicate with our API and sign transactions accordingly so that they're read by the smart contract, then whatever security process you have, you can integrate with this system. So that's really how we think about kind of networking liquidity across different venues, is that it's really about connecting these custody solutions together so that everyone can execute and trade within one specific venue, but without having to give up control to a third party through kind of pre-funding and turning over control of custody like we have today.
That makes a lot of sense. I mean, do you think that you guys are inherently kind of linked to the centralized exchanges just because people have to use them as on-ramps to convert USD or fiat to Bitcoin or Ethereum per se, and then trade on IDEX or just Ethereum? Or do you view that kind of not as an issue long term if we go to a fully crypto digital world?
So we look at that as kind of a temporary, just kind of given the phase that we're at in our growth. So I think you're absolutely right that today to trade on IDEX, it's you're not coming straight from your bank account to trade on IDEX. We are looking at different fiat integration solutions. So there's a few competitors. I guess they're not competitors; they'd be partners for us. But there's a few players in the market that have started to focus on that particular use case of fiat on-ramp directly into crypto. So they're not giving you a full service trading venue, but they're giving you a way to link your bank account and move money in and out of a limited set of cryptocurrencies. So these are really interesting partners for us because it allows us to have fiat integration into the IDEX platform without standing up that full business line ourselves. One of the things though that we think about there is, do we need to have that fiat integration just yet? So if you think about the typical IDEX customer, they understand the value of self-custody. They're able to manage the custody of cryptocurrency and private keys. They're a pretty sophisticated user. So we don't really find many people that come into our support and ask, how do I get Ether to trade on IDEX? They're usually a few steps ahead of that already. So it's something that we think will be necessary to expand the market longer term. But, given kind of the technical nature of the product and some of the just development areas that we still have to work on, really around the UX of the platform, as well as just the broader ecosystem challenge of how do we make this stuff easier to use, better wallets, better private key security. That's going to be an evolution in and of itself that then in the future makes direct fiat integration more important for new customers.
That's an incredible color there. And, I think one of the issues is that the centralized exchanges are just so easily targeted by regulations. And we could see that with all the geofencing activity going on now, especially with Circle and others. What's your take on that? Do you think that's like the US is basically killing this industry, or do you think that this totally benefits your model? What are your thoughts on regulations here for the centralized exchanges?
Yeah, so certainly a hot topic. We actually do not think that the nature of the design of your platform, centralized, decentralized, kind of the method of transaction, is ultimately going to matter from a regulatory perspective. So we made an announcement end of last year. It wasn't very popular at the time, but we started to see other products follow suit that we're going to be instituting KYC on IDEX. We're going to be rolling that out here in a few months. And ultimately, a few weeks. And ultimately, there was some recent guidance from FinCEN discussing this. And our interpretation is that the form of the application, be it you custody or you use a set of smart contracts to custody and transact between customers, ultimately doesn't matter to regulators. If you're involved in the operations of this platform, they are going to consider you an operator, potentially a money transmitter. This was the recent FinCEN guidance. And they're going to want you to have to do some elements of compliance. So as far as we can tell, every centralized and decentralized exchange design that we've seen today will eventually have to acknowledge and implement these policies. A prime example being Bancor just a few weeks ago announced that they are blocking IP from U.S. customers and asking users to self-identify and blocking any U.S. customers from participating. That's just in spite of the fact that they use a more fully quote unquote decentralized model than design than we do at IDEX. So I think it'll be interesting to see how other decentralized exchanges kind of approach this as it unfolds.
That's super interesting. So do you think that if there's quote unquote here, a full decentralized exchange and they get regulated, do you think they'll try and, fight the power by having people spin up new interfaces and websites to interact with their smart contracts? Or do you kind of think that that's like a losing battle to fight the power here?
Yeah, so I think if you really wanted a fully decentralized exchange, you have to model it after Bitcoin in the sense that it should be developed anonymously. It should be launched by an anonymous team or individual. And then after that, it should be pretty much hands off in terms of development. It should be community driven. It shouldn't have, if you can go on Twitter and see the creator tweeting about their product and telling users about how great it is or the new development features they've created, I think ultimately regulators are going to want to talk to that individual. So we think that model is interesting. We do think that there's going to be projects that evolve and create a system that way. But I think it's going to be more community oriented and driven than some of the other existing products that we see today. From our perspective, we looked at that kind of the other question is not only how would you have to do it, but then what is the resulting product? And as you mentioned, you need to have clear separation of what's being done by the network. And then you're kind of playing a game of whack-a-mole with the front end application that interacts with the network. Certainly, you're not able to take the level of control that we do in terms of our hybrid architecture if you want to have this sort of design. So, we kind of see our space in the market as acknowledging what we think will be our regulatory requirements and really pushing on this unique value proposition of non-custodial, the idea that you can trade in a performant application, but you can use any custody solution that you like in order to manage the custody of funds throughout the entire process.
Yeah, the incentive there is huge. So basically what you're saying is if your smart contracts are safe, which you guys have been around a long time, and I don't think there have been any issues yet that I'm aware of. But you never need a SAFU fund like Binance because people are always have custody of their assets here.
Yeah, so there's a couple interesting elements. So one is just, are the funds still there? So if you've been following the Quadriga case out of Canada, it's pretty crazy. It seems like the owner had taken funds out starting years ago and had been leverage trading them on BitMEX and other venues, I guess in an attempt to increase the value and just trade using customers' funds. But that platform has seemingly been insolvent for months or years before its eventual collapse after the founder's death. So that certainly can't happen because it's all transparently in the contract. And then the other piece is just around fund security in the event of the worst case scenario where something happens to the exchange's infrastructure. If someone were to get into our platform, they couldn't take your funds. The worst thing they could do is prevent a trade from settling on the network. But your funds are always yours, and you can always withdraw them from the exchange and from the contract itself directly from the network. And I think you're going to see, it's likely that this continues to evolve this way, even elsewhere in crypto trading. So the vertical integration of custody, trade, and settlement all into one platform like we have in cryptocurrency, it's a bit of an anomaly in the financial markets. Pretty much every other trading process has those three processes separated. And there's a couple interesting implications of that. So there was I think it was a quote from Bernie Madoff talking about some of the, his Ponzi scheme and how I think they use their own custody, like their own custodian to manage their books. And if they hadn't done so, he never would have been able to pull off what he did, because any third party custodian would have seen that this just does not line up. What you're reporting in terms of portfolio performance does not line up with what we have as custodians. So there's even just kind of regulatory or kind of moral hazard reasons to have those processes be separate. And we think that we're looking to build really the best technology solution to do so, where you can have a high-performant trading venue in any custody solution. You don't have to do this integration based on trust or third-party agreements. Any custody solution from the individual up to the institution can plug in and trade with one another.
That's super interesting. And, on the centralized exchange argument and the institutional kind of interest, I guess one way to look at it would be if you guys are attracting people who are wanting to trade, large amounts of assets or small amounts of assets. And I know you spoke earlier that the people that come to IDEX are generally a little more sophisticated because they have to go through, a few more hurdles to get on the platform, like MetaMask, and already have crypto. Do you think that you guys are now attracting larger trades or more institutional investors or traders? Or do you think that might be a ways out? And I know for some assets, probably it is the case because you're the only shop in town for some assets, but I guess people would be more interested in the trends for Bitcoin and Ethereum on IDEX.
Yeah, so it's definitely an evolution, and I think we're still at the early phases of it, but we can see it kind of happening through our metrics. So one of the things we look at, if you think about, again, going back to how do you measure usage and adoption, an exchange market is a two-sided market. You've got, obviously, the buyers and sellers, or in exchange parlance, the makers and takers. So the makers generally provide liquidity. Their goal is to always be there with a bid or an ask on the books such that anyone who comes along has an order that they can fill. The takers are the ones that actually initiate the order, and they're going to be the ones whose activity is reflected in the more public-facing metrics of the platform. In particular, kind of exchange volume, right? So in order to have a high level of trading volume, you need a lot of takers initiating trades. So what we found is that the trade volume, either number of trades or USD denominated or Ether denominated value of trades, has generally tracked kind of the broader cryptocurrency market. So it was stronger in early 2018, pulled back towards the end of 2018, and then has been picking back up since the beginning of 2019. But on the other side, we also look at market maker activity, which is those who are providing those quotes on the books, that form of liquidity, such that there's always an order for a taker to choose. And what we've seen there is that kind of ideal hockey stick startup growth, where we've seen consistent increases month over month in the amount of order placements and liquidity that's being provided by market makers. So we look at that as a sign of continued adoption by those who maybe aren't quite at the institutional level yet, but have a more professional kind of business-minded approach to trading on these platforms.
That makes a lot of sense. And last question on the centralized exchange front. Do you think that IDEX is more focused on person-to-person trading, or do you think eventually, which would compete with the centralized exchanges, or do you think eventually IDEX can fully or in part kind of be an abstracted part away of like the Ethereum stack, where you have dApps and smart contracts exchanging value and tokens between themselves?
Yeah, so we think about this a lot. And I think for at least the short term, we've made a conscious decision to focus on something that's a little more trader oriented, if you will. And it really comes around to that decision to optimize on the trading UX, in particular with regards to a low cost option, not having to pay gas every time you want to do an action, as well as something that's fast and responsive. So we really want the UX to feel like that of a centralized exchange. So that means we're going to be more going after users who are interested in trading these assets for their trading purposes, rather than some of these more integration-focused type applications where dApps, a classic example is you're trying to use a decentralized application. It requires a token and you have Ether. You just want that to be abstracted away. You just want to click a button and it pays whatever you need to pay for its usage. That our model is admittedly not as well designed for that because of some of the steps that are required to get the performant trading experience. So we're really focused on the latter, that performant experience, at least in the short term. You mentioned kind of peer-to-peer. So that's another element where today we see the majority of our usage is individual customers using a private key via MetaMask, Ledger, some sort of self-custody solution. But over time, we're starting to see more interest, and we plan to shift more and more of our efforts to onboarding customers in bulk, so to speak, by integrating with eventually custody solutions themselves. So custodians, as long as they can read and write to our API and sign messages that the contract can interpret, then they can offer their customers access to the IDEX platform while still maintaining their own security practices around custody. So that's where we think it gets really interesting because, again, whatever your flavor of custody solution, if you can integrate with our API, which anyone technically can, it's just a matter of doing the work, then you can integrate with the system.
Super interesting. And, I like that you guys are focused because a lot of projects in the space are throwing darts at the wall. And, building on the DEX question and diving into that area, you guys obviously have a lot of competitors. And I think two of the more well-known ones are 0x and Uniswap. 0x is old. They have a good developer community, but I think they've definitely made some issues and are trying to find a value for their token. And Uniswap is new, it's taken off. And I kind of view that as more app to app and smart contract to smart contract usage. And we've kind of seen that because it's being used with token sets with DAI and Bitcoin and Ethereum. How do you kind of think about your competitors here outside of what we previously discussed with your trade-offs? Do you think that you guys have competitors or do you think that these guys are, kind of too far behind you guys? How do you view them?
Yeah, so it's interesting. We just maybe a quick story. When we launched in early October, late September 2017, it was, I want to say, a few weeks or maybe a couple months right after the 0x token sale. And we struggled a little bit early on with getting traction because we were met by a lot of criticisms of, well, what do we need another DEX for? 0x is here. There's a bunch of relayers coming online. And we actually looked at building on 0x, but in order to keep our hybrid design, which we feel is so critical to our UX, we would have to actually make some trade-offs. It would be less efficient, and it wasn't the right fit to use their contracts for that purpose. So we chose the road less traveled and rolled our own smart contracts. And we think that ultimately paid off when we started to get more customers because we were able to have a much better UX. So to put a specific point around that, one of the challenges with a 0x design has to do with trade failures and this idea that anyone is able to take an order from the order books because it's a more open approach. Because you don't have someone coordinating that process, you can actually have trades that fail at the network level. Either intentionally, someone's trying to front run you and jump in front of your trade in order to take that order out from underneath you, or unintentionally just because multiple users are trying to get to the same order at the same time because it's the best order on the books. They're working to address all those things, but we think they're frankly making it a little unnecessarily complicated with some of their approaches to doing this on chain. But we're certainly watching with interest because they're a high quality team from a technical perspective, and they've done a lot of good kind of development in that area. The other kind of set of competitors that you mentioned are, in particular, Uniswap and Kyber, which use what's known as a automated market maker model. The concept here is that instead of having what's known as a CLOB, which I love that term, but a central limit order book, which is what you think of with the typical exchange, where you have specific bid and ask orders of certain size and price, and then matching or trade kind of execution is done at the order level. Instead of having that approach, you have a smart contract that essentially has a function to determine how much to offer at all times of a certain pair of assets. So in the Uniswap case, you'll have pairs of tokens with Ether, say Augur and Ether. And it's a process whereby it consistently offers tokens for sale as well as Ether for sale. And if someone buys more tokens, then the price goes up. And if someone sells more tokens, the price will go down. In some ways, it's not very good because it's a very unsophisticated market making approach. It's essentially the first one to get picked off in the event that prices move, because prices don't update until someone executes against it. However, at the same time, it's got a unique value proposition because it allows anyone to market make without really having to think about it. You can just put your funds in the contract and it will offer them to customers at a certain price. So they've done some really cool things around bootstrapping liquidity there. But back to your question, just after describing that a little bit, back to your question around how do we look at these products? I think the first thing I kind of think about with the automated market maker versus central limit order book is we think that most traders vastly prefer the latter. If you see all of the centralized exchanges, they've gone this approach of allowing market makers to provide a specific bid ask. They don't force them into a specific market making function, so to speak. They give them the flexibility to determine at what price levels and what amounts they want to set their orders. Similarly, in traditional finance, there's been attempts at automated market making. Dutch auction is another method of trying different models, and they've never really taken off. There's a clear market preference for central limit order books. So that's kind of one of the things. The second is we look at, what's the value to end users of this approach? And it's really around this kind of integration with other applications, the ability for other dApps to call a contract directly and get back a certain amount of assets in often one transaction. But we already actually have this product today, and it's possible that centralized exchanges could offer this same service, like a public endpoint where you could send funds and receive back an unknown amount, but based on liquidity on the books. And we had that in the form of Shapeshift. And it was always a less desired product in comparison to other traditional centralized exchanges. And then maybe to kind of my third point here, which ties back to regulation, which is Shapeshift has recently struggled once it brought in KYC, which points to me that a lot of the value proposition that came from Shapeshift was not necessarily the simpler UX, but perhaps the lack of regulatory oversight. So I think that once some of these automated market maker models start to butt up against some of the regulatory challenges, or the products that integrate with them start to butt up against those challenges, for example, Maker and Dai has indicated that they're working towards a broker-dealer license. I don't know what a KYC'd Maker Dai creation process would look like, or maybe they'll have it on their front end. It remains to be seen, again, how you kind of police this stuff. But I think ultimately those products may struggle in the face of growing regulatory pressure if they're not able to keep that seamless contract-to-contract transactions.
Couldn't agree more. And that's a great way to look at why Shapeshift was important or why they're falling off now. I think that's great color. And just building on, the centralized exchange and decentralized exchange dynamics here, what's your take on the centralized exchanges that are trying to disrupt themselves in a way by, tacking on a decentralized exchange? And I think Binance is, the most obvious example here. They're a huge centralized exchange. They have like 600 trading pairs. They're if not the largest exchange, but they're also adding Binance DEX on there. What's your take here? Do you think that they're trying to move into your water, or do you think that this isn't really competitive long term? I'm just wondering your take there.
Yeah, a couple thoughts. So Binance Chain is interesting. It's interesting that they're not just trying to build out a DEX, but actually promote their own blockchain. So I think that's an interesting approach. And I think it's in some ways it's smart because they want to try to capture more of that token issuance process. But another, it's kind of against some of the ethos of crypto, which is companies build on top of open and permissionless applications. And at the moment, at least, Binance Chain is very far from being either of those two. Right? It's fully operated by Binance. They control all of the nodes, and there's functionality in there to undo pretty much any transaction. So, is it sufficiently decentralized to meet their goals? Maybe. I think that remains to be seen. From our perspective, we're not focused on building out our own network. We want to make the best platform that can trade across all networks. That includes Ethereum, things like EOS, Polkadot, and if Binance adds the ability to do smart contracts in the future, Binance Chain as well. So we're not trying to pick a winner in terms of which platform is going to be the most successful. We're looking at how can we bring what we believe is a superior DEX design to any number of different smart contract capable platforms.
That's awesome, color. And, there's a good transition. Let's go off the competition for a bit and let's talk about your token, what's going on there. I know there was a few blog posts from you about Aurora DAO and then the transition to the IDEX token. And I also had David Hoffman on Twitter ask me also to ask you what the deal is with the membership token and justification for that. I guess if you could just give an overview of what the token is, and then we could go into any stats you have on staking.
Sure, absolutely. So just to briefly kind of address the transition. So we launched with a parent-child brand strategy. It was Aurora was the parent, IDEX was the first product we were building. We've got intentions to build other products, but we've since realized that everyone knows us for IDEX. Whenever we introduced ourselves at conferences as the team from Aurora, we'd get puzzled looks. And then immediately, if we said we build IDEX, a lot of acknowledgement and understanding. So, we know when to embrace something. So we've recently brought all of our branding under the IDEX name. In terms of the IDEX token, so we have a two token model. So the one that was being asked about on Twitter is our IDEX membership. So this allows people to trade for the next 2 years for free on IDEX. So it's an alternative form of paying for trade fees. So rather than paying for each trade one at a time, you can purchase this membership, which allows you to get discounted up to full discount on your trade fees. The token that we think is more interesting, though, is known as IDEX token. And this is a staking token that has a role in the operations of the IDEX platform. So without going into too much detail on proof of stake, but it's a different form of consensus mechanism where people are putting up, instead of compute power, like proof of work, they're putting up capital in the form of a stake. This capital is used to incentivize them to act honestly in terms of operating nodes in the network. And if they try to act dishonestly, then they risk losing that stake. Currently, IDEX users are able to stake the IDEX token and run a node in the network that's serving up trade history. So when customers connect to IDEX, rather than getting the trade history directly from our database, customers are getting it from a specific node that's reading it directly from the network. So it's kind of a unique model that we can incorporate because of the fact that our trades are all written into the contract in a more open and transparent manner. And we've seen a lot of success with it. So for the role of what they're doing, these stakers actually earn a percentage of the fees that are collected by IDEX. They're currently earning 25% of the fees. And you asked a little bit about stats. So we launched the staking network in mid-January of 2019. We've had, I think, 10 staking payout periods since launch, where we've paid out almost 1,000 Ether worth of fees to these staking customers. The last payout period over the last 2 weeks was for a little over 100 Ether, and it was for a little over $33,000 in USD terms. So this is a really interesting model that has a couple components that we're trying to get in terms of incentive mechanisms. So first off, the staking token is given away to those who trade on the IDEX platform, proportional to the liquidity and volume that you provide. So we're really trying to accelerate that network effect of liquidity and trading, where the more liquidity you bring, the more trading you do, the more of this token you earn. You then have the ability to stake that token and actually earn a percentage of the fees from the platform. So we have, I think at this point, over 300 nodes that are live, different customers that are operating and staking the platform. And based on the recent period, the current yield is around 15, 16%. One last comment there on the yield side. So a lot of staking networks are funding the yield via inflation or block rewards, meaning they're paying out stakers by giving them more of the underlying staking token, which can look good on paper, but ultimately, if everyone is staking, then your real return is zero. It's kind of like looking at inflation and traditional currencies and thinking that you have more money just because you're keeping up with inflation. So in this case, our rewards are entirely funded by transaction fees. So it's already a sustainable business model behind the staking platform. And we're really excited by really where this can go over the next 5-10 years as IDEX continues to grow, not only on the Ethereum platform, but expand elsewhere.
Alex, you guys are one of the quietest yet most innovative teams I think I've spoken to. Going to the first token, IDXM, which is your membership for free trades, do you see that as having a lifespan beyond the 2-year period? Like, are there other use cases you could tack on there? I'm just wondering about the longevity of that token.
Yeah, so one other use case, I mentioned the rewards program that we have. So this will last for the duration of the rewards program, where IDXM users can choose between free trades or earning those rewards at twice the rate. We actually see that most members go for the latter, which is a great sign for us because it means people are bought into kind of the long-term vision of the platform, this idea that it can be owned and operated by those who are trading and providing liquidity and giving it value. So that's a really important component for us to be measuring is just are we communicating the value proposition to our customers of where this staking network can go in the future.
Gotcha. That makes a lot of sense. And then switching over to the staking token, I mean, is this in line with kind of decentralizing IDEX over time? And, is that kind of the long-term goal here? Or is this more to, say, increase security and increase your user base and your stakeholder base?
Yeah, so it's a bit of both. So I think we look at token economics as a unique way to incentivize people to all work towards the same goal. And it was kind of pioneered by Bitcoin, whose main value proposition as a currency or store of value is potential future price increases. And if everyone who is interested in developing in Bitcoin, evangelizing it, has an economic upside to its growth, then you're going to do so more passionately. So we kind of look at this model for exchanges of how can we add a token to the application that incentivizes people to help the application grow. So provide more liquidity, stake a node and actually make it more robust and more secure. So to your second point around security, this is going to also have a role in our layer 2 scaling solution. So we haven't touched on it yet, but the basic idea is to reduce the amount of information that we're sending to the Ethereum blockchain by bringing more of the computation off-chain. And in this case, those that are running a node and validating transactions are going to also be responsible for helping secure the information that's being sent to the chain. So really the long-term goal is that twofold: to increase the performance and security of the platform while also harnessing the network effect that's unique to a well-designed token model.
That makes a lot of sense. And do you think that you'll attract stakeholders that want to validate the network, or do you think you're attracting more speculators at this time? I'm just trying to get a sense of what the makeup is for the staking token, because it is the first time I'm hearing about it, obviously, before the podcast, but I haven't heard much about it. And it seems like the sustainable model of it makes a lot of sense here.
From what we can tell, most of the people that find out about it are interested in the staking aspect. So, I think what we're seeing for 2019 so far is that staking tokens are definitely a trend. People are trying to think about how can I, be participating in a network and getting rewarded for providing value to that network, right? So it's a different form of kind of capital asset in the sense that you're not just hoping that the network value increases and that it influences your crypto asset, but you also have the opportunity to improve the network by lending compute resources, helping with validation, helping with the security. So I think that's an attractive model for a lot of people in the crypto space. And that's generally what we've seen in terms of people that are attracted to the IDEX token.
So Alex, the staking of the Aura token, or now the IDEX token, I apologize if I confused that. I'll let you correct me after this. But, how do you view that long term? I know 0x is trying to basically implement governance rights through its token, and that kind of makes sense to decentralize and control of the platform. What's your take on, governance of IDEX or the Aura token, or, correct me on where I'm confusing these two things?
Sure. Yeah. So as I mentioned, we transitioned to everything as IDEX brand. And as part of that was officially swapping the Aura token associated with Aurora for the IDEX token. So going forward, it's known as the IDEX token. We think that we're really in the early days of kind of crypto asset or crypto token design. And a lot of it's, people have kind of understood that you have this unique opportunity to build something that everyone can be incentivized to move in the same direction, to promote it, to support it, to spend time either using it or just really make this ecosystem more valuable. And there's a lot of ideas on how to do that. And I think you're seeing some of them being debunked. So, for example, the idea of a fee token, that this is going to be the currency of our mini economy. You have Taco Coin, and everyone who wants to eat tacos is going to spend Taco Coin, and all the taco makers are going to take Taco Coin. That's been pretty much dismissed as an idea simply because of what's known as the velocity problem. The idea that taco eaters don't really want to hold Taco Coin for any longer than they need to buy it. And taco producers have real world expenses in dollars or whatever other currency. So they're going to sell it as soon as they get it. It's not really good for supporting. You could have a really robust taco ecosystem without having much value in Taco Coin. So people are looking at other models. What are other ways to give value to these assets? One of the ideas is governance. If you have something that's valuable that people want to govern, then logically they might pay some amount in order to be able to do so. We think that still remains to be seen how valuable that is. One potential example is the fact that DEX, the top 0x relayer, actually chose to fork the 0x protocol and make their own version. So they actually decided that governance wasn't worth anything and they'd rather do their own version. So, we're really looking at staking as a unique, one of the few models that we think has really been shown to have some value. Another way of framing it is this right to work token. So you can think of it almost as a taxi medallion, where it gives you the ability to perform some work within this ecosystem. In this case, you can participate as an IDEX node, you can help secure the network, you can process transactions, and you get paid a percentage of the fees that IDEX collects. So that encourages you not only to run a better node and be a better participant in the network, but also to evangelize about IDEX, trade more on IDEX, incentivize your friends or other community members to help the platform grow.
That makes a lot of sense. And, closing out on IDEX itself, you guys released news of a potential layer 2 solution. And you spoke about this earlier, but basically the goal is to bring transactions off the main chain, increase throughput. And there's a lot of ways to do this: state channels, payment channels, plasma, take your pick. And we have a layer 2 report we just released on this as well. What are your plans here, if you can discuss them, and what are the ultimate goals of it?
Yeah, so we're not at the point where we want to reveal too much on the technical front, but I think I can say that we're really excited by what we've created because there's kind of a unique position in the market compared to all the other scaling solutions that we've seen to date. So, maybe just to address kind of at a higher level the goals of layer 2 and some of the challenges we've seen with others. So, as you said, the goal with a layer 2 solution is kind of what it sounds like. It's an additional layer on top of the primary chain. The goal being to bring a lot of the computations or data storage or the information off of the main chain into this second layer, with the goal of minimizing the amount of resources that we use on the primary chain, layer 1. And this goes back to the same reason earlier that we don't want a fully on-chain DEX, because every action costs money, and the more actions you do, the more you have to pay. So, fun fact, in 2018, IDEX users paid over $4.3 million in gas fees to get their transaction mined by the Ethereum network. It was almost 3% of the total network fees that were collected by Ethereum. So Ethereum miners love us, but our users are really kind of clamoring for us to help address this issue of high transaction costs. So this is what we're doing. Yes, this is what we're doing with our layer 2 solution. So, some of the other solutions out there, there's a couple of different challenges. So sometimes they have challenges with moving data or information or value in and out of the layer 2. There's what's known as exit games on some of the Plasma solutions, things that make it a little problematic when you want to get your funds out. Some of the other ones use very advanced cryptography approaches, in particular snarks and starks, which, while promising, are still very much in their infancy and have shown to have bugs in implementation in other processes, and in particular in privacy coins. So that's a little scary for us when we're already a large business. We have a lot of value flowing through the system, and we want to have something that's really tightly scoped and robust. So that's been kind of driving our design decisions when it comes to our layer 2 solution. And the goal here is really to retain the private key signature. The idea that every action that happens on IDEX requires your approval to initiate it, while at the same time minimizing the amount of resources that we use. And we've come up with a design that allows us to scale essentially infinitely. We can pack an infinite number of transactions into one single transaction that we submit to the network every, say, 5 to 10 minutes. So we'll batch process the information that's happening on IDEX, submit it to the network in one single transaction, and drastically reduce the cost of using the network. Perhaps more importantly, we break that linear relationship between number of trades and the cost of using the underlying network. And we think it's going to be such an improvement that we're actually planning to offer gas-free trades on IDEX. So we'll be able to take that cost on ourselves as operators, and users will no longer have to worry about network congestion or gas fees. So more details to come soon on the exact implementation. We're working on, obviously, testnet version. We'll have a white paper and everything for others to dig in, but I think we're really excited about what we've created here.
That's incredible. I mean, that would be a serious improvement. Do you think that when you release your solution, people will use your scaling tech for other use cases, or do you think that it's only going to be for you guys and it's going to be somewhat closed source? I'm just trying to get a sense, because it seems like your layer 2 tech could be used across a number of different verticals, even beyond an exchange.
Absolutely. So I think one of the reasons that we're going to be able to achieve better throughput than competitors on our solution is because we're very tightly focused with the implementation. So a lot of layer 2 solutions are looking for a more generalized approach. Maybe they're actually, that's their product is scaling for any type of application. So because we're tightly focused on trading, there's some elements that we can kind of optimize that can make it a little more performant. But I think longer term, we're going to think about how can we open this up and apply it to a more general set of purposes and applications. Everything's going to be open source, so the community will have an opportunity to dig into what we've built and see how they can modify it and apply it for their own needs. Again, this is in contrast to some of the other scaling solutions that use snarks or starks, where some of the computational components, some of the secret sauce is remaining closed source and within those companies. So, we really think that open source approach is best, not only for the success of the community, but also in terms of convincing people that this scaling solution actually is as solid as we say it is, right? If you can't dig into the code and see how it's working under the covers, then it's really hard to trust it with millions of dollars of value, which is what we're doing today and what we want to continue doing in the future.
That makes a lot of sense. And Alex, just a couple rapid fire questions for you before I let you go. You shared so much incredible detail with us. What is your take on the Ethereum community? Like, what would cause you guys to move and build on a different layer 1? Or is that a bad question?
So I don't think I'd be shocked if we ever don't build on Ethereum, in the sense that, Ethereum has paved the way in so many areas. It was the natural place for a decentralized exchange to start for two primary reasons. One, it was the first one that really had a robust set of smart contracts that you could build something like this. And two, it's been the area that's seen the most asset issuance. So you need the capability to build it, and you need something for people to trade. And really, for the time being, Ethereum is still the top spot for that. So, however, we look at our scaling solution as something that will be universally applicable to any platform that has smart contract capabilities. So we certainly have intentions of expanding beyond Ethereum, but it's less for performance characteristics and more about asset availability. So, for example, I personally think that some platforms may be better suited for security token issuance, for example. We haven't seen a lot of adoption with that on Ethereum, and I think there actually may be some challenges with implementing smart contracts in such a way that will get securities regulators comfortable with kind of the risk of using that as a primary form of business. So I think it's likely we'll see other platforms that pop up that have those assets, and that's certainly something that we want to do to bring IDEX to operate on those other platforms as well. So, of course, nothing's guaranteed, but if I had to guess, we'll always be on Ethereum, but we won't be solely Ethereum. We're really looking at supporting a broader set of smart contract platforms in the future.
Gotcha. And last question for you, Alex. We already talked about BNB a lot, but we'd be remiss not to discuss Bitfinex's LEO token. What's your take on this? I mean, there's obviously some really straightforward and simple token economics that are linked to like a legitimate business, and I think people are resonating with that. But there's also, a lot of outstanding questions. What's your take on that, considering you guys have a token and, you've done a lot of work on looking at other exchange-based tokens as well?
Yeah, so I'm not as familiar with LEO as I should be, but I'll give this a stab. So I think a couple of thoughts. So one thing's interesting is I always kind of question this with BNB. They had intentions to buy back up to half of the supply. At which point it was unclear what would happen with those buy and burns. So if they don't continue indefinitely, then it's hard to think of that as a kind of value flow back to token holders. Kind of the mental model is that buy and burn is similar to a dividend, and you can think about it as a cash flow back to this, in this case, token holders. And you could use something like a DCF or an NPV formula to figure out what you'd be willing to pay for a set amount of tokens today. So the fact that it's only going to a period of time, and then I think recently they updated the white paper to, instead of saying it's a percentage of profits, it's now an undisclosed amount or something like that. I think they might struggle to keep what is possibly the most interesting part of it as part of their token economics going forward. I think similarly with LEO, my understanding is they're using a percentage of profits to buy back the token, which if they can keep it, certainly you'd expect it to have upward price pressure on the asset. But it's possible that they need to make same decisions as Binance in the future and change that model. It's also not 100%. You may have a better insight on this than me, but if someone's buying and burning an asset, I guess maybe let me restate this. So people think about this as a dividend because shareholders they think about this buyback as similar to a stockholder buyback, where there's less in circulation and now it's worth more. But in that case, it's worth more because there's less of the equity that has a claim on a specific cash flow, a specific set of assets of that business. In this case, there's less of an intangible asset that, if they ever stop the buybacks, doesn't have a claim on anything within the company. So, whether or not that's the right mental model, I'm still not 100% sure. So, we kind of contrast this with IDEX, where our goal right now, it's 25% of the fees are going back to those who are staking the token. And eventually 100% of the fees will go back to those who are staking. And we, the company, will be staking a percentage ourselves in order to continue funding further development. So this model, we think, is unique because all value will flow back to those that are actually operating and supporting the network, similar to how other crypto networks operate, where you have all of the block rewards, all of the transaction fees going to those that are mining the network. So we think that long-term, this is really a unique and sustainable model for kind of the community-driven exchange, where it's really operated by those who are making it valuable.
Great caller. And last question, Alex, for you. I promise. I'm chatting with my partner, Jan, earlier, and we're kind of discussing transaction fees and layer 2 a bit. What's your take on like the staking tokens income from transaction fees if your layer 2 kind of makes fees go like way down? Do you kind of just make up for it on way higher transactions, or how do you kind of think through that?
Oh, so that's a great distinction. So when I'm referring to reduced fees, I'm referring to reduced network fees, the Ethereum gas fees for processing transactions. So that's what I was referring to in 2018, where users paid $4.3 million to the Ethereum network. So that did not go to us to help fund further development. It went to miners in order to process those trades. So the real question for us is, how can we keep the security of having the compute power of the Ethereum network kind of powering our smart contracts and the security of the non-custodial trading solution, while at the same time reducing the amount of information we send to the blockchain and hence the amount that we have to pay for that security. So that's really what the layer 2 solution is all about.
That's an excellent distinction. Alex, I wish you the best with all of everything you're working on. You have a ton under the hood, and I can't wait to speak again on anything that pops up.
Awesome. Thank you, Tom. Appreciate the time.
Hey everyone, thanks for listening to the episode. If you learned anything, please share the episode on Twitter and LinkedIn. Feel free to tag us and visit delphidigital.io to learn more about our research.